Palantir just posted $1.63 billion in total revenue, delivering a crushing 85% growth rate, yet underneath this celebrated outperformance lies a hidden trap that could wipe out your portfolio's gains. Is this celebrated company truly the next unstoppable artificial intelligence monopoly, or a carefully constructed house of cards? Looking at the staggering 133% year-over-year increase in United States commercial revenue, the narrative feels invincible. Mainstream analysts see that $1.63 billion in total revenue and immediately assume undisputed global dominance. But strip out that massive domestic surge, which hit $595 million, and we calculate that international revenue grew at a significantly slower rate of roughly 37%. Explosive domestic enterprise adoption is single-handedly carrying the stock valuation higher, leaving your investment positions highly vulnerable to localized market volatility. And this is exactly why your fundamental analysis must go beyond the flashy headlines. But to fully grasp why the broader market ignores this inherent weakness, we need to carefully look at their profitability. Gross margin expanded to an elite 86.8% this quarter. This metric simply measures the profit left over after paying the direct costs of delivering software. How is profitability vastly outpacing hypergrowth? Normally, scaling at these blistering speeds burns massive capital, yet they expanded their GAAP operating margin from 20% to a massive 46% in just a single year. Operating margin shows what percentage of revenue remains after covering day-to-day expenses. The underlying company achieved an unprecedented Rule of 40 score of 145%. The Rule of 40 is a benchmark adding revenue growth and profit margin to measure elite software performance, and Palantir shattered it. The trade implication here is profoundly lucrative for you. You are buying elite operating leverage, proving mathematically that their artificial intelligence software requires virtually zero marginal cost to deploy once the platform is established. However, before you back up the truck to buy shares, we must address a glaring financial anomaly. While quarter-over-quarter total revenue grew 16%, the accounts receivable balance jumped by an alarming 34.8%. Accounts receivable represents money customers owe the company but haven't paid yet. Are they quietly loosening their strict credit standards to close massive enterprise deals? Financial Bulls will tell you that a growing accounts receivable balance of $1.41 billion simply reflects robust sales momentum. But when outstanding customer invoices grow at more than double the rate of incoming sales, expanding rapidly from a prior accounts receivable balance of $1.04 billion, it signals the company might be extending highly favorable delayed payment terms to clients. The golden rule here is that booked accounting revenue does not equal cash deposited in the bank. Thankfully, they generated $899 million in operating cash flow to cushion this blow. But this is exactly why relying on top-line sales growth alone is a dangerous game in your daily stock market analysis. Fortunately, Palantir possesses a unique financial insurance policy against possible delayed payments. The company currently commands an impenetrable $8 billion in liquid reserves. What exactly is the executive management team actively planning to do with this colossal capital reserve? With exactly $0 in traditional debt, Wall Street praises this fortress balance sheet as the ultimate defensive safety net. To put this in perspective, their current ratio stands at 6.91, meaning they have almost 7 times more liquid assets than short-term liabilities. Yet, despite generating a massive 53% net margin, management is entirely abstaining from any dividend payments or share buybacks, choosing instead to relentlessly stockpile capital. For your investing strategy, this aggressive capital hoarding signals a profound strategic pivot. Leadership is either bracing for severe systemic market volatility, or they are preparing for opportunistic corporate acquisitions to violently consolidate the artificial intelligence infrastructure landscape. But stockpiling cash comes at a deeply hidden price, and retail shareholders are permanently footing the silent bill. During the most recent quarter, the company recognized a staggering $201.6 million in stock-based compensation. Stock-based compensation means paying employees with company shares instead of cash, directly diluting your ownership. Who is truly paying the premium for all this explosive commercial growth? Inexperienced market participants blindly celebrate the high earnings, ignoring that this stock-based compensation equates to 12.3% of total revenue. Delving deeper into the fundamental analysis, we see that $76.9 million of that compensation went exclusively to the sales and marketing departments. This structural cost acts as a hidden wealth transfer paid to retain top-tier talent, continuously diluting your equity ownership even as the company posts consecutive record profits. As an active investor, you must continuously weigh whether the headline commercial expansion is fast enough to continually outrun this relentless baseline equity dilution over the long term. This is something you can easily check for yourself, and once you grasp this, you'll start to look at financial reports in a completely new light. The company recently reported a non-GAAP adjusted net income of $856.4 million. Why are their carefully sanitized adjusted profits actually significantly lower than their raw, unadjusted accounting profits? Usually, management teams use adjusted figures to hide ugly operating expenses and artificially inflate their earnings numbers. But here, the unadjusted GAAP net income was actually higher at $870.5 million. This immense cognitive dissonance exists because management conservatively applied a theoretical 23% long-term effective tax rate to its non-GAAP calculations. By doing this, they deducted over $243.6 million from the bottom line. But if you look at their actual GAAP tax provision, they only paid $12.2 million, resulting in a microscopic real-world effective tax rate of just 1.3%. The real lesson here is that you must always relentlessly audit the complex bridge between non-GAAP and true GAAP financial metrics. This is exactly why proper value investing requires reading the footnotes. Never take artificially sanitized earnings metrics at face value when deploying your hard-earned capital. Management proudly touts $2.41 billion in total contract value closed during the recent quarter. Total contract value measures the entire projected lifetime revenue of all newly signed customer agreements. But how genuinely solid is this massive commercial pipeline? The general financial market blindly treats this $2.41 billion as guaranteed future cash flow, aggressively bidding up the core stock price on the comforting promise of secure long-term revenue visibility. They happily highlight that the company closed 206 deals worth over $1 million each. However, the underlying regulatory fine print clearly states that the vast majority of these specific enterprise contracts are fully subject to termination for convenience by the client. This means this massive backlog could evaporate if corporate IT budgets tighten during an unexpected economic slowdown. It means management's forward-looking financial guidance is fundamentally far more fragile than the spectacular headline numbers suggest, leaving your long positions exposed to sudden enterprise spending freezes. Your ongoing stock market analysis must constantly monitor this invisible trapdoor. So, how exactly does a software company justify these massive foundational risks and command such an incredibly aggressive valuation? The core underlying strategic narrative centers entirely on the company's unprecedented 145% Rule of 40 score. Can a software vendor genuinely command a physical hardware-level valuation premium? Traditional software peers are strictly valued on standard enterprise application multiples, historically anchored to relatively modest operational efficiency metrics. But by explicitly comparing their immense forward momentum to physical hardware giants, Palantir is perfectly repositioning itself as a foundational infrastructure layer. Management recently raised their full-year revenue guidance to an astonishing $7.66 billion, deliberately demanding a massive structural market premium from sophisticated institutional buyers. They even raised their domestic growth forecast, projecting 120% United States commercial revenue guidance. Your personal investing strategy must recognize this deliberate narrative shift. You are no longer simply pricing a basic data analytics tool, you are being actively asked to underwrite the foundational operating system of the modern artificial intelligence economy. This monumental psychological pivot is the exact specific reason why the stock currently behaves much more like a dominant semiconductor manufacturer than a traditional cloud software provider. We must now definitively return to our vital opening question. Is this explosive 85% year-over-year total revenue growth the dawn of a new technological monopoly, or a fundamentally fragile trap for your investment capital? The ultimate truth is that Palantir is successfully transforming from an unproven software vendor into a massively profitable cash-generating machine. However, its profoundly asymmetrical reliance on domestic commercial momentum makes it incredibly vulnerable to rapidly shifting local market dynamics. The absolute core takeaway for your portfolio is that while the underlying operating leverage is undeniably elite today, you must aggressively hedge your positions against the lagging international adoption and the relentless compounding equity dilution. That is precisely why I boldly believe that within the next 24 months, Palantir will aggressively execute a massive multi-billion-dollar global strategic acquisition using its unencumbered $8 billion in cash reserves, entirely shifting its fundamental business model to secure an absolute monopoly and forcing the broader financial market to violently reprice its stock forever. But I want to hear your take. Do you think Palantir's explosive domestic growth can sustain its massive valuation, or is the international lag a ticking time bomb for the stock? Let me know in the comments. So hit subscribe so you won't miss what's next, and jump straight to the next video, because that could be the very insight you need to get ahead.